In 1720, investors lost everything chasing companies that promised an undertaking of great advantage, but nobody to know what it is. Today, over 95% of leading AI startups generate almost no returns, yet insiders cash out billions on hype. This is not just the next tech bubble. It is a replay of history's worst financial illusions, set to collide with a system built on credit and belief. What happens when the foundation of innovation itself becomes a house of cards? Speculative mania does not begin with numbers or spreadsheets. It starts with a story. In 1720, the South Sea Company lured investors with a promise so vague it became infamous, an undertaking of great advantage, but nobody to know what it is. 3 centuries later, the same dynamic drives the AI boom. Crowds are not drawn to balance sheets. They are drawn to narratives, to the idea that missing out means being left behind in the next industrial revolution. Financial historians have long observed that in every major bubble, rational people act irrationally together. The crowd is swept along by the conviction that the market cannot be wrong. Charles Mackay wrote that men go mad in herds and only recover their senses slowly, one by one. In the current AI frenzy, this madness is global. Investors from Tokyo to New York pour capital into companies whose core assets are buzzwords: generative, disruptive, AGI, not revenue. The signals are everywhere. MIT reports that 95% of companies investing in AI are seeing zero returns. Yet valuations soar, justified not by cash flow, but by the hope of future dominance. The insiders, those who craft the narrative, have learned that the right combination of technical jargon and grand vision can substitute for any evidence of actual profit. The story is the product and the crowd is buying. Speculative mania is not just about over-optimism, it is about the suspension of skepticism, the collective belief that this time, the rules do not apply. When valuation is set by narrative, not numbers, the line between innovation and illusion disappears. Perplexity is a name that rarely makes headlines outside of tech circles, but in 2025 it became a case study in story-driven valuation. At the start of that year, Perplexity's revenue sat at $148 million, respectable for a young company, but hardly enough to justify the $18 billion price tag attached to its latest funding round. That is a revenue multiple of 120 times, a figure that would have seemed absurd in any previous era, even during the dot-com bubble. Yet investors lined up, drawn by the promise of exponential growth and the allure of being early to the next big thing. The company's core business, prosumer subscriptions, and a fledgling enterprise API showed rapid user growth, but actual revenue lagged far behind the narrative. Major funding rounds triggered waves of secondary share sales, as founders and early backers quietly cashed out portions of their holdings. These liquidity events often coincided with high-profile product launches or press coverage, reinforcing the illusion of unstoppable momentum. In July, Accel led a $100 million extension to the Series E round, pushing the valuation to $18 billion. By September, rumors swirled of new commitments at $20 billion, even as the underlying business remained deeply reliant on venture capital to cover infrastructure costs. This pattern is not unique. Across the AI sector, secondary sales and insider liquidity offers cluster around moments of peak hype, allowing those closest to the narrative to lock in real gains while the public chases paper returns. The gap between valuation and revenue is not a rounding error. It is the defining feature. When insiders cash out at 120 times revenue, it is not just a bet on the future. It is a transfer of risk from those who know the most to those who know the least. The entire structure rests on confidence that the story will hold. When that confidence breaks, the numbers alone will not cushion the fall. Hidden leverage. Margin debt in 1929 let ordinary Americans buy stocks with just 10% down, fueling a frenzy that ended in disaster. But the leverage building behind today's AI boom is both larger and harder to see. Prime brokers now extend margin loans to hedge funds and family offices, financing concentrated bets on AI giants like NVIDIA, Microsoft, and Alphabet. Standard haircuts for these stocks are as low as 20% for top clients, meaning a fund can control $5 of stock for every dollar of its own money. In mid-2025, prime broker filings show $110 to $150 billion in margin loans tied directly to AI stocks. This is an absolute figure that rivals the inflation-adjusted margin debt of 1929, but now embedded in far more complex portfolios. Synthetic leverage. The real amplification comes from synthetic leverage. Total return swaps and equity derivatives referencing the leading AI names have exploded, with notional values topping $1.2 trillion. Hedge funds routinely run exposures of 3 to 7 times their capital, layering swaps and options on top of margin loans. Some of the largest U.S. dealers report risk multiples as high as 9 times posted cash for their most active clients in AI. Structured products and leveraged ETFs add another layer, with $800 billion in monthly open interest on AI-linked call options and over $130 billion in leveraged sector funds by mid-2025. Institutional risk. Retail investors participate too, but the most dangerous exposures are institutional. Synthetic leverage is distributed through banks, prime brokers, swap dealers, and asset managers, all holding overlapping claims on the same volatile assets. Unlike 1929, where the danger was visible on retail margin ledgers, today's risk is buried in derivative books and private credit agreements. When volatility hits, these layers can unwind at algorithmic speed, triggering forced sales and margin calls across the global system. The amplification potential is not just in the size of the bets, but in the speed and opacity of the network that links them. Inferno Compute's collapse in March 2024 revealed how quickly risk can jump from one corner of the market to the entire system. The firm, once a darling of the GPU leasing boom, saw its credit lines pulled after a missed payment to a major hardware supplier. Within 12 hours, Tier 1 banks began reviewing their exposure. By the next morning, internal risk memos circulated with a blunt warning. A single failed margin call could cascade across 20 to 30% of total fund equity. The first margin calls landed before markets opened. Hedge funds that had pledged Inferno Compute shares as collateral faced immediate liquidation. Their forced sales triggered price drops in the leading AI equities held across dozens of portfolios. Synthetic positions, total return swaps, and options layered on top amplified the move. Automated risk systems, programmed to protect the banks, started demanding more collateral from clients, regardless of whether they held Inferno Compute directly. Within 48 hours, 3 major funds sought emergency loans from the Federal Reserve discount window to avoid dumping billions in AI stocks onto the market all at once. The speed stunned even veteran risk officers. Unlike past crises, where weeks separated a company's failure from broader contagion, this shock rippled through global portfolios in less than 2 days. The language from the bank memo, 20 to 30% of fund equity at risk, became a rallying point for regulators who suddenly understood that, in the new world of synthetic leverage, a single weak link could threaten the entire chain. The fallout forced a reevaluation of how quickly a localized failure can freeze credit and threaten the wider economy. OpenAI's $300 billion multi-year contract with Oracle stands as a monument to the scale and complexity of modern AI finance. This is not just a vendor agreement. It is a binding commitment that ties together the fortunes of 2 of the world's most powerful technology firms. Oracle, once known for databases, now underwrites the infrastructure behind the largest AI models, blending service revenue and vendor financing into a single massive obligation. Across the sector, data center capital expenditures are projected to exceed $1 trillion globally by 2027, with most of that figure funded through syndicated loans, commercial mortgage-backed securities, and private credit. Nearly 80% of new data center construction is debt-financed, often with non-recourse structures that cross-collateralize dozens of sites. When a single tenant falters or capital dries up, losses can ripple across entire portfolios. The depth of these ties means that risk is no longer isolated. Every major lender, hardware supplier, and cloud provider is now entangled in the same web, with exposures that reach far beyond the tech sector itself. History rewards those who protect capital when the crowd is chasing dreams. During the Great Depression, investors with cash or government bonds watched as fortunes vanished around them. U.S. Treasuries returned over 20% from 1929 to 1932, while stocks lost nearly 90% of their value. In the South Sea collapse, landowners and holders of government annuities preserved their wealth as paper shares became worthless. Gold has also served as a crisis hedge. When markets unraveled in 2008, gold rose by 25%, while equities were cut in half. The lesson is consistent. Avoid leverage. Avoid speculative assets, especially those priced on hype. Hold a mix of cash, short-term government bills, and hard assets that produce real income or utility, such as farmland, select commodities, or property outside the speculative core. Diversify across regions. Some markets recover faster or are less exposed to the epicenter of the crash. Above all, resist the temptation to chase returns in sectors everyone says can swap. Today, over $2 trillion in global assets rest on AI promises, most yet to deliver real returns. As markets chase narratives instead of fundamentals, trust in innovation and finance hangs in the balance. The next crash won't just erase wealth, it will test the very foundation of belief.